You've often said that the market growth converges with earnings growth.
In India, earnings cannot revive without financials leading from the front. If you look at the last 12 to 15 months, India has underperformed massively. If you have to score 300 runs in 50 overs, one of the top 4 batsmen has to hit a century.
What was your assessment on the budget? Were you shocked with the STT news?
I mean, STT will take away 10,000 extra crores, I think. As it is, 70 to 80% of the expenditure is non-discretionary. You have interest payments, salaries, pensions, subsidies, which are sticky.
When you talk about metrics like that, what are some of the top metrics that you go by?
So I think the TAM is very important for me. Every 7-8 years, people write obituaries of Indian IT companies. You start in 1999 when Y2K happened, then Lehman crisis, then PIX crisis, and then the last and most important, before I come to valuation.
Hi everyone and welcome to the podcast. Our guest today, Gautam Duggad, is known for his sharp reading of earnings cycles, shifting profit pools and sector leadership. As head of research at Motilal Oswal, he has consistently argued that sustainable market rallies are built on earnings and not exuberance. At a time when global macros, geopolitics, AI disruption and valuations are colliding, his emphasis on selectivity and discipline really stands out. Today he joins me as we talk about his roadmap for the markets, top sectors and wealth creation in a rapidly changing world. Gautam, thank you so much for joining us. I want to start off with what's on the mind of the market right now, and that would undoubtedly be the trade deal. The fact that we're now the 4th lowest country in terms of tariffs by the United States, I think that came as a huge surprise and a nice positive one, given that no one was expecting it at this time. Your reaction and what does it mean for India?
So thanks for having me here. I think the timing of the deal is big surprise, and of course the quantum of the cut that we have seen from being the most tariff nation at 50% to now 18%. We are now, as you rightly said, the 4th lowest in terms of the tariffs that are applicable to a particular country. So it has come as a huge positive surprise. And as it comes on the back of a big EU deal that we saw, I think a week back, I think 2 big blocks on the planet have now concluded the trade deal with us. It materially changes the sentiment insofar as foreign investors are concerned, because this was acting as a big hangover for them.
Yes.
If you look at the last 12 to 15 months, India has underperformed massively. Now, there are multiple factors responsible for it, one of them being the slowdown in earnings that we saw after FY24. Then you have seen the Capex slowdown, which was right after the elections. Third, the currency has been very volatile for us, and currency has robbed off the returns for most of the foreign portfolio investors by 5 to 6% in the last 6-8 months. And on top of that, you had so many other geopolitical headwinds which were clouding the direction of the market. So we've seen massive outflows. In the context of the market cap, they look very small, but in the absolute terms, having lost $25 billion on foreign outflows in the last 15 months, that also impacted the sentiment. Right. So therefore, this trade deal is not just an event which comes and goes away. The way we are looking at it at Motilal Oswal from a house point of view is, this is an allocation event. The ramifications of the deal that got announced, I think will be felt weeks and months ahead. It's not a one-day kind of an event. So it's very difficult to, digest the event in 1 or 2 days. I think market will keep reacting to this as more and more clarity emerges. But for now, it's a major sentiment booster. And at the same time, it hopefully helps reverse the direction of the FI outflows that we've been seeing in the markets.
Okay. So let's talk about those 3 things that you flagged off that were concerns. The Capex, you said, was slowing down. Earnings growth had slowed down in currency. Does the trade deal to a great extent alleviate a lot of these concerns, maybe especially when it comes to the currency? To a great extent?
Yes, absolutely. And that's where we have seen the reaction today in the market, in the currency market. I think currency is up by about 1%, 1.5%. Look, the deal doesn't change the contours of the corporate earnings for many sectors. Very few sectors got impacted. Which is why when the trade deal was not happening, we kept telling people that, this doesn't have an impact from a bottom-up perspective. But it definitely has an impact from a top-down perspective.
More sentimental.
More macro, more sentimental. India getting singled out. Words like geopolitical isolation were being bandied about. Right? Now suddenly in 7 days, you've seen 2 big blocks concluding that deal. So what kind of geopolitical isolation are we talking about, right? So this is more a macro event, which is more important for the P multiples of the country rather than bottom up, what impact it has on an index earning. Very few sectors actually got materially impacted. And even the sectors which got impacted have very small representation in the indices. So you have textile, which is widely discussed. Then there is gems and jewelry. There's very little representation in the stock market right now.
Fair. So that's one piece of the puzzle. Now, if we were to pick up the other one, which you're an expert at talking about, and that is earnings growth. And you've often said that the market growth converges with earnings growth. And you have some solid data to back that up. So can you give it to us? Can you break it down for those people who are like, I'm skeptical about that metric? What do you want to tell them?
So look, let's travel back 10, 15 years. 2010 to 2020, for 10 years, India's earnings went nowhere. Like we've seen, I think 4 or 5% compounding in corporate earnings in that 10-year era. And there were a host of factors responsible for that slowdown. You had, big asset quality cycle which played out in the first part of the decade from 2012 to 2018. You had many cyclical sectors which went through slowdown. Real estate, infrastructure, telecom, a lot of Capex sectors went through slowdown. The entire 4 or 5% earnings growth that you saw in that 10-year era was led by 3 sectors, which are essentially defensives: private banks, consumer and IT. In fact, when I look at my data in our Motilal Oswal coverage universe of 350 stocks today, in 2010, these 3 sectors used to contribute 22% of the corporate earnings. In 2020, they became 45% of the earnings, because the rest of the 20 sectors did virtually nothing. Things turned around post-COVID. So 2020 was the very important year insofar as the direction of earnings is concerned. You saw first double-digit earnings growth in FY21. And then FY22 saw almost 35-40% earnings growth. 23 again witnessed a bit of a moderation because of the huge flare-up in commodity prices. 24 again you saw 20% plus earnings growth. So between 2020 to 2024, the earnings compounded at 25% for Nifty 500, which is the widest benchmark, which accounts for 90% of India's market cap. Markets literally converged with that earnings growth. Markets gave you more than 20% compounding, notwithstanding the problems happening in the world at that point of time. You had Russia-Ukraine from March 22. You had Israel-Hamas, which began, I think, in October 23. And there were a lot of other problems concerning the world. But India kept doing well because the corporate earnings was growing at a very fast rate. Now, FY25 is the first year of moderation that we saw. Right after the election year.
What was it, 3 to 4%?
It was 4% for Nifty, 1% in terms of Nifty EPS. And for the broader markets, it was about again 5-6%. So what happened that year? The elections, they took a lot of time. Those 5-6 months, a lot of inertia sets in the bureaucracy, in the policy circles. So that brought the pace of Capex down, right? And then of course, you had a very high base of financial earnings. We'll come to that because it's a big chunk of the earnings. Be that as it may, FY25 was the first year of a earnings slowdown. And then FY26 followed suit. This year also, we are still talking about 7-8% earnings growth. But if you split this year into 2 halves, first half was very bad. You had a very flattish earning. This is a quarter where things are looking slightly brighter. So now last 2 years earnings went nowhere. So market also gave you a very stagnant kind of a return. Last year Nifty was up 10-11%. This year it's already down. I mean, if you ignore today's move, 3-4%. So between September 24 to almost March 26, which is a period of 18 months, markets went nowhere. So market usually respects corporate earnings from a slightly longer term perspective. Short term, obviously, it's an amalgamation of sentiments, liquidity and news flow. So we are now hopeful that things are changing for the better, especially some of the big sectors. See, reason what happened, Aman, was 3 big sectors, the financials, consumer and IT. They all started slowing down. So financials had a very solid 10-year period, or rather 7-8-year period. 2018, the earnings bottomed out in financials. When the asset quality worsened, it was like, you saw 2018 numbers, companies like SBI, Axis barely reported profit, or some even reported losses. In that year, the total profit pool for Motilal Oswal Financials coverage of 70 stocks was somewhere about 48-49,000 crores. It became 5 lakh crores in FY25. So in 7 years, you saw 10x jump in financial earnings,
Yeah.
largely because the asset quality improved. You have companies like SBI and many other banks reporting 0.3, 0.4% net NPA now, from what used to be 3.5% 7, 8 years back.
Yeah.
Credit costs have become 25, 40 basis points. ROEs for PSU banks for 4th or 5th year in a row is upwards of 15%. So we've gone through a massive upcycle in financials earnings. Now, on that base, it's very difficult to grow at 20% for them because the incremental tailwind from asset quality is limited.
Yeah.
So now what we are seeing for last 1.5 years, the credit growth, the NII growth, the PPOP growth, and the profit growth, all of them are converging.
Okay.
Because very little juice is left beyond PPOP line now. So if your credit growth is 11-12%, your profit growth will also more or less be in the similar range.
Okay.
So that is 36% of your corporate earnings in Nifty.
Okay.
And then you had IT, which has started growing at 8-10% now, especially large cap because they are the ones which are represented in Nifty 50. And then consumption also has seen hardly 7-8% growth.
Yeah.
So you have about 60% of the profit pool which was growing in mid to high single digit or very low double digit.
Okay.
And that is what took a disproportionate toll on the Nifty earnings. Now we are seeing earnings moving towards 13-14% back.
Okay.
Which
so
is a
will it be
recovery.
will it be the sectors that lead from the front when it comes to earnings revival will primarily be financials, consumption and IT?
Look, in India, earnings cannot revive without financials leading from the front.
Okay.
Right? It's like in cricket terminology, if you have to score 300 runs in 50 overs, one of the top 4 batsmen has to hit a century.
Okay.
Right? So financials take that role.
Okay.
So this year also in FY27, when we are talking about 17% earnings growth for Nifty, it is primarily led by financials, where we are projecting about 18% growth. And then you have some sectors which come and join the party. Like this year we are expecting metals to really lead from the front. We are expecting about 30% plus earnings growth in metals. Auto we are expecting more than 25%. So this 2-3 sectors put together will drive 70% of incremental earnings. And then you have somewhat smaller sectors with index weight ranging between 2.5 to 3.5%, something like a telecom, something like a cement. Cement has done very well in FY26. Maybe it will catch up with the high base in FY27. But financials has to lead from the front. Otherwise, market earnings cannot grow beyond a point. Which is what we've seen in FY25 and 26.
Okay, that's interesting. And I'm going to come to those sectors, metals and auto. But budget was also a big event. And some would say that, given that we did see tinkering with GST and IT returns, there was not much that happened on that front. But all in all, we weren't going in with big bang expectations. And that's exactly what was delivered. What was your assessment on the budget? How much do you give it on 10? Were you shocked with the STT news?
So look, we published our budget preview 3 weeks back. And in that we had written very clearly that we have very low expectations from budget. Because if you look at the fiscal maths, this government is very conscious of fiscal consolidation, which is very good for the Indian macros. Your nominal GDP growth is in 8 to 10% band. Last year it was 8. This year we were expecting them to assume a 10% number, which is what they've done. With that kind of number, if you're going from 4.4 to 4.3% on fiscal deficit, and with, of course, the larger overarching ambition of reaching net debt to GDP by about 50%, I think they've taken that target plus minus 1%. So the levers that the finance minister had to play around on expenditure are very limited. As it is, 70 to 80% of the expenditure is non-discretionary. You have interest payments, salaries, pensions, subsidies, which are sticky. So you have hardly 10 or 20% of the budget to play around with. Out of which last year they had already given income tax cuts. The GST cuts had come outside of the budget. I mean, look at it this way. If instead of, I think, August or September, they had announced the GST cuts in budget, it would have become a headline and budget would have been called a dream budget, right? But because they did it 6 months back, and this was more like a business as usual budget with more focus on fiscal consolidation, policy continuity, and at the margin they've prioritized certain sectors like AI, data centers, Capex, even defense spending. So in overall 6.5 or 7% growth in expenditure, they've taken 10% or 11% higher number for Capex, and within that defense by about 18 to 20%. So I would say it's a very stable, boring budget, which is what investors need. STT obviously came as a bit of a surprise, but look at it this way. I mean, STT will take away 10,000 extra crores, I think.
Yeah.
but it had a huge sentiment impact.
Oh, yeah.
Because this government, and I think even SEBI and other policymakers have been highlighting that they want to curb the excesses in the speculative markets or derivative market.
Yeah.
So market will get adjusted to it after a day or two. In fact, we hosted a call with expert on F&O yesterday, and the conclusion which emerged was this will have impact more on futures and less on options, and that too very margin. In fact, if you go into the data, 2 years back also the government had raised the STT on futures and option. After that, for last 18 or 20 months, there's not been much change in terms of the average volumes.
Oh, is it?
Yeah.
Okay. But you had spoken about the entire capital market ecosystem coming alive, brokers, AMCs, exchanges, wealth managers. Does this STT structure risk now come as a dampener to this or challenge this thesis?
Look, there are two ways to look at it. One, for those investors who have a 3, 6, 9-month horizon, they should stay away from these sectors because inherently they are very cyclical. They are capital market linked sectors, and capital market in turn is sentiment led market. So you cannot predict short-term returns there. You can't predict it for any sector, but more difficult for cyclical sectors like this. Why we are so positive and bullish on this segment is we think India is turning from a nation of savers to investors.
Yeah.
Right. The data is well known. 4 crore demat accounts to we've now reached 21.6 crore in 6 years. 6 years is yet to complete by March 26. Right. You've seen massive jump in equity AUM. I remember when I joined Motilal Oswal in August 2012, the total equity AUM of India was 2 lakh crores.
Yeah.
Today it is 40 lakh crores, and there are at least 10 mutual funds which are individually managing more than 2 lakh crores.
Yeah.
And there are several schemes which are now touching 1 lakh crore. We expect this to continue to compound at a 15 to 20% clip in the next 10 years. Now, who benefits from this? There is a whole ecosystem of capital market participants, some of which you already mentioned. You have brokers, you have exchanges, you have asset managers, wealth managers, depositories, and then there are several other intermediaries. Right? I think many of these companies will benefit, some to a larger extent, some to a smaller extent. But the whole capital market ecosystem in India has come alive post-COVID. And I think people have realized that staying invested in the market for a slightly longer time period and instead of just playing around, that has given them a very different test. Right? 12-14% is what the markets have delivered over the last 15 years. Last 4 years were unusual. Between 2022 to 2025, people have made more than 25%. But now they are learning in the last 1.5 years, especially this new crop of investors who have come in. The demat account which got added in the last 4 years, as I mentioned, about 18 crore demat accounts got added. Those 18 crore demat accounts have not seen a long or a durable period of correction, which they are now witnessing. I think this will create more maturity in those investors in terms of the expectations that they have from capital markets. So once they have gone through a cycle, I think again the capital market ecosystem and the stocks linked to that will make a big comeback. So we are positive. In fact, we've highlighted in our note also that any correction in some of these stocks is a very good buying opportunity in our view, as long as you have a 3 to 5 year view.
Long-term view, yeah. You've also said that consumption remains key, but staples are losing their relevance. Is there some sort of a structural change in spending habits that you're seeing? What is driving this?
So what happened is consumer staples for the last 10 years, if you look at the data points, there's not a single consumer staple company in India which has given a 10% compounded top line growth, right? That has almost translated into a similar bottom line growth. Now, this company saw massive re-rating in the period between 2010 to 20, more so between 2015 to 20 because we were going through a lot of headwinds. You had GST, you had IBC, you had demonetization. The corporate earnings of other sectors got damaged.
Yeah.
People were looking for safety. And that is where consumer sector came into picture. You were getting 10-12% assured earnings growth, more defensive, higher ROEs, higher payout ratios and all. So the multiples of many of these stocks got re-rated from 30-35 to 60-70 in that period of 5 years.
Right.
I mean, I'll just use Hindustan Lever as a representative of that segment because it's the bellwether. The P of Hindustan Lever went up 3.5 times in the era between 2009 to 2021. Right? Now, last 5 years, almost the stock has done nothing, while earnings have compounded at 8 to 10% or maybe slightly lesser. the P is still at about 50 times. Now, if you're growing at 8 to 10%, right, and it's very difficult to estimate numbers for any of the consumer staple company beyond 15%, because volume growth has started stagnating in that 3 to 6% band. Beyond a point, price hikes are becoming a deterrent because competitive intensity has gone up from alternate channels. So you have this direct to consumer brands, a lot of this e-commerce, quick commerce. So that has put a cap on the kind of pricing power these companies used to enjoy 15, 20 years back. And third and most important, the penetration levels of many of the categories in consumer staples have reached 80, 90, 95%.
Yeah.
I mean, if you look at 2007, which is when I started tracking consumer sector, the oral care penetration in India was 72%. And there were 4 or 5 years, I don't remember the exact 4-year period, when Colgate reported a double-digit volume growth of 10 to 14%. 2014 is when oral care penetration reached 95 or 96%. Now you look at the last 10 or 11 years of top-line compounding of Colgate, it's somewhere close to 4 or 5%.
Yeah.
So penetration has reached a particular level.
Right.
Now the growth has to come from premiumization.
Okay.
And premiumization is a slave of income growth, which is what got damaged post-COVID. We think staples are a good 8-10% story. For that, the valuations need to correct a bit more, or they need to undergo more time correction.
Okay.
We are more biased towards discretionary. In fact, in my model portfolio, now we have a zero allocation to consumer staples.
Okay.
We've been underweight on it for 5 years. In July 2025, we've removed the only consumer stack that we had and made a consumer staple allocation zero. So entire 15% allocation that we have in consumption is towards discretionary stocks.
Okay. Now, Titan has continued to remain a favorite, and despite the fact that there has been slower earnings growth, what is giving it an edge?
I mean, I've been tracking this company for last 18 years now, and I've had this as a top idea for most of those 18-year period. I think for 15 or 16 years, Titan has been our number one preferred discretionary consumption idea in India. Even today, it is our top pick in discretionary. The reason is twofold. One is the size of the category in which they are present. It's a $80-85 billion TAM. Very few consumer categories in India, whether discretionary or staple, have that kind of a landscape available to them. Second, they have been the leaders by a margin.
Okay.
And despite so many regional players coming in, raising the competitive intensity in that category, Titan has not lost the market share. In fact, the growth also, if you look at it, I mean, if I give you data, on the day of demonetization, that is, I think 8th November 2016, the price was somewhere about 340, 350. Since then, for the last 10 years, and it was a well-discovered stock even then. 40, 50 analysts covering it. It was a renowned consumer name with very marquee holders. In the last 10 years, the earnings have compounded at 25%. And stock has compounded at 30%, despite it being an expensive name to begin with. Now, it used to trade at 35 to 37 times. Today, of course, it is trading at 65 to 70 times. Our conviction comes from the growth.
Okay.
Right? And having seen it over different 5-year blocks, where different players came, tried to increase their market share in different regions, Titan stood tall.
Yeah.
And I think the kind of market share that they have today, even today they are less than 7% of the industry. So the runway for them is pretty large.
Okay.
Maybe they may not compound earnings at 25% now on this base, but 17 to 20% compounding looks very feasible to us.
Okay.
And I mean, if you look at other categories and discretionary, at least you have 4 or 5 worthy players who are competing with them. Here is the only category where the dominance is sustained for more than 3 decades, and the next best player is still 1/10 or 1/5 of Titan.
Okay, so the growth and the numbers have spoken for themselves.
And of course, intangibles like the trust that is inherent
fair.
in a category like gold, and you have
Yeah.
Tata Group out there. So
Sure.
you can't put that into Excel sheet,
Fair.
but market values it.
And when you talk about metrics like that, what are some of the top metrics that you go by apart from earnings growth to look at a company to say, hey, it meets my criteria, this is worth it?
So I think the TAM is very important for me, the category.
Okay.
I mean, that decides how big you can become.
Okay.
Now, you can be
The
a very
addressable market.
addressable market size.
Okay, that's
Second,
one.
Second, what right you have to win in that category? Is it your brand? Is it your distribution network? Is it your pricing power?
Yeah.
Or market share dominance?
So what's
For
your USP essentially?
Yeah, what's your USP
Yeah.
basically? So, companies like ITC have, a huge dominance in cigarette.
Okay.
You have companies like Pidilite, which is not allowed any competition to enter in that category beyond a point.
So you're right
That is
to
second, right to win. Third is we all talk about future. And any company you go, if you go to meet 1,000 companies in India, all 1,000 companies will tell you the future is bright.
Yeah.
What I put a lot of emphasis on is the past track record.
Track record.
If they have demonstrated a good track record for last 5-10 years, like for example, since we are talking consumption, and everybody has been saying India is a consumption story, which I don't disagree with, but not every consumer company is going to benefit from that. Because the previous 10 years, we've not seen a single consumer staple company delivering 10% growth.
Okay.
So you have to see who's done that track record. And then the last and most important, before I come to valuation, is the importance of balance sheet and cash flow. See, what has happened is, given the abundance of data, most of us have ended up becoming a P&L investors. We look at P&L broadly, and then look at the price to earning. It's 40p, 60p, 80p. We decide this is expensive, we move out of it. And that's why I gave you an example of Titan. There are many such examples.
Okay.
You had HDFC Bank for 20 years running, it compounded at more than 25%, despite being the most expensive bank.
Yeah.
Same thing applied to Kotak Bank, Chola, Bajaj Finance. So P alone doesn't decide the next 5-10 years of return. There are multiple parameters that go into it. And sectors that I've inherently liked over the years tend to have better free cash flows versus their competition, much better balance sheet quality.
Okay.
But as a consequence, the stocks that I like are never cheap.
Okay.
So you'll always find in our model portfolio, or the stocks that I recommend, very few stocks will have valuations which will make you say, okay, this is very cheap stock. Because my style is growth investing.
Okay.
And I'm willing to pay for that as long as my conviction on the growth remains.
And valuation, finally, a reasonable valuation.
Yeah. So I'm not fixated on a particular number of P. I'm fixated on growth.
Okay.
Right. And we've seen it, even companies like Dixon we have seen.
Yeah.
Right. From a 2,000 crore market cap in 2017, it was still considered as expensive then. 7 years later, it reached a 1 lakh crore market cap. Because the earnings compounded at 40%.
Fair.
Trent was another example. So there are many examples where, despite stocks being expensive on a 1 year forward PE basis, they've created tremendous wealth.
Well, you've said for technology, you've warned against using that old lens to judge the sector. What do you like in IT, and with things changing so rapidly with technological innovations and AI, what should one be watching for in IT as metrics? So
one thing I've learned in technology is, every 7-8 years, people write obituaries of Indian IT companies. You start in 1999 when Y2K happened, then Lehman crisis, then PIX crisis, then 2017-18 again some macro crisis globally happened. It was related to trade deal or some such thing.
Yeah.
And then COVID, and now again people are using AI to write obituaries. See, IT sector, no one will deny, for large cap Indian IT companies, the growth rates have come off significantly.
Yeah.
There was a block of 4-5 years where they used to grow at 30. Progressively, it came down from 30 to 20 to 15 to now 8 to 10%.
Yeah.
So you have to decide two things in IT. Do you want stable returns, or do you want, higher growth and higher returns? Because the two categories are very different. If you stick to just IT, predominantly IT, you have 6 large cap IT companies which are growing at 8 to 10%. But they account for 90% of the profit pool and 92% of the market cap. They are trading at 20 to 23 times. So if you are an institutional investor, obviously you cannot ignore them.
Yeah.
Because of the liquidity, the weight in the index, the weight in the benchmark. And there the things change depending on the market sentiments. So we were underweight IT for a very long period. We changed our call to overweight in November when we thought that the index weight has halved in the last 4 years. 15 out of 20 funds, or more than 15 out of 20 funds, were underweight IT.
Okay.
Currency was helping them, currency was depreciating. And we thought incrementally the growth can, see an uptick of 2-3%. From 5 to 6%, we are expecting 8 to 9% in next 18 months. So then we felt the risk reward is incrementally more favorable now, and which is when we added large cap IT.
So what is it that you like within the IT space?
So we added Infosys. Tech Mahindra we've been holding for a very long time. And now coming to mid cap IT, because they are growing at 20 to 25%. So you have companies like Coforge, companies like Persistent, companies like Hexaware, they're growing anywhere between 15 to 20% band. But they are available at more than 30 Ps, right? And when markets correct, Mid caps, obviously, because of the higher beta inherent in them, they will correct more. So my choice is a blend of both.
Okay.
Mid cap IT for growth and large cap IT for stability in this kind of a market.
Okay. What about names that you've highlighted in the past? Radico, Khaitan, you spoke about Dixon Technologies, etc. What is it that stands out, and which are some of the other stocks that look attractive?
So look, just to complete that point on tech, a lot of new age tech companies have also come in, and a lot of stuff has been written about them. Selectively, we like a few of them. We have Zomato in our model portfolio. In the past, we used to have Swiggy also. I won't call Grow as a new age as such, but yeah, within the capital market, that's a relatively newer age company, which we added in our model portfolio. And there are sundry other names which got listed in the last 3 months, which we still don't have coverage upon, but some of them we like. Coming to the names that you mentioned, so Radico was an interesting addition for us. When we added it in July, we had removed Hindustan Lever and replaced it with Radico Khaitan. Again, the reason was growth. Right? If you look at the journey of Radico in the last 15 years, the company has transformed, both in terms of balance sheet, cash flow, and of course in terms of P&L. Right? It's the only homegrown IMFL company which has created brands organically, and they've created multiple brands in the IMFL space, be it brandy, whiskey, rum, vodka, and some of their premium brands, the ultra premium brands rather, they retail at a higher price than the MNC brands of Diageo. And then you look at the growth for last 3 or 4 years. The volume growth, I think, has anywhere between 15 to 20%. Earnings growth has been more than 25 to 30%. The problem with this stock was it had run up too fast too soon. But that's the nature of the market. When the growth surprises you, market rewards you disproportionately, which is what we saw with Trent also, from 1200 to 8000 in a matter of 3 years. And when growth started falling off, from 40% when the growth came to 17% on top line, stock came off from 8,000 to 3,500. So markets sometimes are very, I won't say the word irrational, but very brutal in terms of rewarding and punishing. So Radico is primarily there because of the growth that we are expecting. We're still expecting more than 30% earnings growth for next 2 years. So Dixon has been a very interesting story for us. Growth has obviously been superlative. And they've expanded the addressable market for themselves. They got into multiple segments. Of course, they are the largest player in the mobile segment. In between, there have been some concerns on some contract with some companies and potential implications for earnings. We've cut our earnings by 30% in the last 1 month for Dixon, for FY26 as well as FY27. The stock has corrected by 45%. So we've now increased our weight on Dixon in our model portfolio. We expect FY27 to see a good recovery. And I think some of the concerns they've assuaged in the conference call that they've done post the third quarter earnings. So we are one of the few houses where the EMS weight in our model portfolio will be 5%. So very chunky overweight. It's a bit risky also, as we have seen in the last 3 months when the stock price is corrected. But as long as that growth delivery comes through, we think the prices will follow.
Metals, it's just been so volatile within this space, but you recently said that we are going to see this earnings revival. So that means that the entire space is going to see an up move?
Look, metals is very difficult to take a long-term view. Because it's a cyclical sector. So many factors contribute to their performance, both fundamental and price. China plays a very important role. Global cycle on commodities plays a huge role. Last 6 to 9 months for commodities has been excellent. We have seen both precious metals, industrial commodities, copper, aluminum, zinc, all of them have done well. And of course, that is reflected in the earnings that we have seen. We've seen earnings upgrade in metal companies in the last 6 months. As I said at the beginning of the conversation, in FY27, metals is one of the big contributor to our incremental earnings. Right? Now, what you have to see is what is already in the price. We've been underweight, so we've missed the bus in metals this year at least. Now, I don't want to chase it now after the stock prices have rallied 3x, 2.5x, because these are not structural stories. You cannot say what the earnings will be 3 years later. I mean, if you look at Tata Steel in FY22, out of nowhere, they did a 40,000 crores of profit. FY22 was a bumper year for commodities all across. In fact, they contributed significantly to the Nifty's 35 or 40% earnings growth in that year. But 6 years later, in FY28, we still don't have 40,000 crores of projection for Tata Steel. That being said, it's part of our model portfolio.
Okay.
We think in metals, you have to be cognizant of two things. Typically, I've seen metals at the peak of the cycle, they look the cheapest.
Okay.
And at the bottom of the cycle, they look the most expensive. And you have to do the reverse. Right? When they look the cheapest, you have to sell. When they look the most expensive, that is when you have to buy. Because that means the earnings is depressed, and that is creating a sort of a playground for you to earn some incremental returns. I think that part is done now. From here, how the earnings compound, because things are changing every day as we speak on commodities front, the kind of excessive volatility we are seeing in commodity prices, I think they will have a huge influence on next 1 or 2 years of earnings. So right now we are underweight on metals, and that's been our stance for a few years now.
Okay. What lessons have you learned, maybe the hard way, in the stock markets, and what are some of the typical mistakes investors make that you think they should avoid?
I think biggest mistake is FOMO.
Yeah.
Right? You arrive late to the party and then you try to, start dancing there, and you are the only one dancing. You don't realize the party is over. So FOMO is a big, big mistake.
Okay.
Second, I think very few of us still understand the concept of asset allocation. I think that's one of the most important thing to learn before starting investing.
Okay.
Right? Asset allocation is something which largely decides the kind of returns you will make in the life cycle of your investing.
Okay.
Right?
Yes.
That is second. Third, lot of times, this is the mistake which even evolved investors will do. We put lesser emphasis on evolving sectors. Things change very rapidly. If you look at financials as a landscape in India, 20 years back as an asset allocator, you had to make a choice only between private and PSU banks. Then came NBFCs. Then 10 years back came insurance companies. 5 years back, asset management companies started listing. And last 3 years, we have seen preponderance of capital market companies coming up and listing. And we still don't have too many fintechs there. So the amount of time that we have to spend in an economy, which we are ourselves saying will move from 4 to 8 trillion in the next 4-5 years, the number of sectors which will emerge, it's very tough to grapple with. We were looking at one data point yesterday. So 5 years back, we used to cover 200 companies. Today, we cover 356 companies. 5 years back also, we were covering 75% of the market cap of India. Today, after almost 70% higher number of companies in coverage, the market cap that we cover is still 75%. So that tells you how rapidly the Indian equity market is evolving. So those are, I think, I would put 3, 4, and of course, you know the usual ones, control over emotions, greed and fear. That's something which is very difficult, and you only achieve with the amount of time you spend in the markets. And today also taught us something. How much time you remain invested in the market is far more important than timing the market.
Absolutely.
Who would have thought 2 days back when budget was announced that in 2 days markets will swing by 5%.
My gosh, yeah, absolutely. So Gautam, now let's move on to a rapid fire round. So that's going to be snappy, quick answers that we want to get from you. If you could fill in the blanks for us, 2026 will be a dash year for the markets.
A very good year for the market.
Okay. Best earnings growth in terms of sectors will be seen in which sector?
Automobiles.
Okay. Bear market, is it a threat or an opportunity?
Opportunity, but you look at it as an opportunity in hindsight.
Okay.
When it is transpiring, you feel scared.
Okay. One investing myth that you just want to bust?
Investing myth?
Yeah.
Staying invested in every stock in a long term will always make you a return. That is not that's a myth.
The best advice you received on investing?
Start early.
Okay, yeah.
And stay invested.
Mid cap versus large cap, what's going to drive the mood of the market this year?
I think it will be large cap, which will create better wealth creation in 2026. Mid caps and small caps have had phenomenal run for last 3 years. They need to take a little bit of breather and allow the earnings to catch up with the valuation.
Has there been any book that's shaped your thinking?
I think the earliest ones which I read from Peter Lynch, they are the ones which are, beating the One Up on Wall Street, pretty good. The capital returns, and the one that I'm reading now, Masterclass with Super Investors, is focused on Indian investors.
Yeah.
So those are some of the books which have helped.
Gautam, it's been a pleasure interacting with you. Lots of key takeaways from this interview, and I'm sure our viewers thoroughly enjoyed it. So that's what we've learned, that the trade deal this time around has been an allocation event, and it's going to have ramifications for the long term. He also spoke about how market growth ultimately converges with earnings growth. There are multiple sectors and stocks as well, which he decoded in the interview. Some classic mistakes are investor FOMO, avoiding speculation, and of course, having a stellar criteria to view stocks such as an addressable market, the right to win, a stellar track record, balance sheet, and valuations. I hope you enjoyed watching this interview. Do remember to like, subscribe, and comment to the video. Thanks so much for tuning in.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.